The ride-sharing company Lyft has seen its stock price jump by 74% in 2025. Of course, I'm happy about that because I rated Lyft stock as a buy for all of 2025, rating it as one of the most undervalued stocks this year. But what about 2026? Is this still an opportunity or is it too late? I'll answer that question in this video, looking at the company's longer-term prospects on revenue, on cash flow, on return on invested capital, weighing it against the biggest risk in driverless car technology, and then revisiting valuations using my proprietary DCF model, and looking at the market multiples valuation, all to come to a conclusion on if long-term investors have an opportunity here for 2026 with Lyft stock.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at Lyft revenue since 2017, they've done an excellent job here, increasing from 1.1 billion in 2017, more than 6x to 6.3 billion, or roughly 6x to 6.3 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 26%. Ride sharing has grown significantly in the United States because of the convenience advantage it offers folks. Furthermore, the soaring cost of car ownership has made Lyft and ride sharing overall even more attractive in the United States, and I expect that will continue for the foreseeable futures as new cars that are coming out and the cost of insurance, the cost of parking, the cost of maintenance are all increasing at rates much faster than inflation and much faster than the price of ride sharing, and that's making Lyft that much more attractive for folks in the United States. Now, I will say that Lyft does not benefit from the economies of scale the way that Uber benefits from, and that's going to be a big factor when I talk about risk a little bit later. The company has also done a nice job at improving the returns on invested capital. Although numbers themselves are not great, it's increased from negative 50% in 2020 up to positive 0.5% in the most recent period. Now, other rideshare and food delivery companies like Uber and DoorDash have demonstrated they can generate lucrative cash flow as the business runs on an asset-light business model. Lyft benefits from that asset-light business model as well. The drivers on the platform are the ones that are bringing the cars to the platform. These are assets that are worth tens of thousands of dollars, and Lyft doesn't need to invest in those assets to generate revenue from the utilization of those assets. That's a very attractive situation for investors. It allows the company to grow without investing significant sums of money on capital expenditure or holding significant working capital. And that allows a excellent growth of cash flow, which I'm sharing with you in this screen here. What you're looking at is the operating cash flow to sales ratio, which measures how many dollars a company turns into cash from a dollar in sales. The higher the number, the better, of course. And Lyft at 17.1%, that was up from 14.7% in the prior year, which is up significantly from 2017, where it was negative 37%. There's been volatility, of course, during the pandemic. You saw that big crash for Lyft. It does not have the food delivery segment that benefited during the pandemic for companies like Uber and DoorDash. It only has ride sharing, and only in the United States, or primarily in the United States. And of course, during lockdown stages, that business was negatively impacted, which is why you saw that significant crash there for operating cash flow for Lyft in 2020, but that has since recovered. And if you draw a line here from 2017 to 2025, you can see a nice upward trend for the company's cash flow to sales. Now, looking at valuation, you can see a very undervalued business here, trading at a price to earnings forward of 17 and a forward price to operating cash flow of 7.8. These are very cheap valuations for a company that's growing revenue at a 25% compounded annual rate, and in most recent years, still double digits, although not as fast as the compounded annual rate over the previous 8 years. And the company is improving its return on invested capital, demonstrating excellent leverage where the costs are staying relatively flat while the revenue is increasing, demonstrating nice improvements in profitability and cash flow. To find a business like that trading at these valuations is rare, but it's because Lyft is facing a significant risk from driverless car technology, and its relatively smaller scale compared to other providers in this industry means it's less attractive as a partner for those autonomous vehicle companies. It's less of a reason to partner with them, whereas Uber provides more of a reason because of the massive scale, all of those customers, all of that data that's extremely valuable. Lyft doesn't offer at that large a scale, so it's exposed to that downside more significantly than other rideshare companies. Furthermore, when I calculated the value of the business using my proprietary DCF model, I found it worth $32, and you can buy the stock at $22, showing that it's undervalued even using my DCF. So the two valuation methods I'm using here, market multiples and DCF, both point to an undervalued stock. And so to update my recommendation, I don't think it's too late, and I still think Lyft stock is an excellent investment for stock market investors for 2026 and beyond. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.